There's a company that manages more money than the economies of most countries produce in a year. You've probably heard that. What you've probably not heard is that the money is the least interesting thing about it. Because BlackRock's power isn't one thing, it's three, stacked on top of each other. And only the first one is money at all. Start with the obvious layer. As of June this year, BlackRock managed $15.3 trillion. That number is almost useless to a human brain, so here's a smaller one that isn't. One single part of the business, iShares, its exchange-traded funds, just crossed $6 trillion on its own. It roughly doubled in 3 years. There is no other asset manager on Earth at this scale. But here's the correction that most of the internet skips, and it matters more than the headline. BlackRock does not own that money, not a cent of it. It's a manager, not an owner. That $15 trillion belongs to pension funds paying retired teachers and nurses, to insurance companies that have to pay out claims, to sovereign wealth funds, and to millions of ordinary people with a workplace pension they've never logged into. If you have a retirement account, some of it may quietly sit in there. BlackRock is paid a fee to look after it. So when someone says BlackRock owns the world, the honest answer is it's holding the world's savings. And there's a real difference.
Which brings us to the second layer, and this is the one almost nobody talks about. BlackRock doesn't just manage money, it sells the software that other people manage money with. It's called Aladdin, a risk system that watches a portfolio and answers one question all day long. If the world changes, what happens to what you own? What happens if rates jump, if oil spikes, if a currency breaks? Now here's the part that should make you sit up. BlackRock sells Aladdin to its own competitors. Rival asset managers, insurers, pension funds, institutions that compete directly with BlackRock for clients, run their portfolios on BlackRock's system.
Think about what that means, because it's a different kind of power entirely. Money you manage can leave. A client gets annoyed, they move their billions somewhere else, and it's gone by Friday. But infrastructure doesn't leave. When your risk reporting, your compliance, your daily view of what you own all run through one system, you don't switch that off in a quarter. You've built your house on it. And BlackRock's own results show where this is going. Technology and subscription revenue grew 13% in a single year, and the contracted value of that business grew 15%. It is the quiet compounding part of the company. The third layer comes from something that sounds boring: index funds. An index fund buys the whole market and holds it, which means it cannot sell. If a company is in the index, the fund owns it, no matter how badly that company behaves, because selling isn't an option the fund has. So BlackRock isn't just a large shareholder in thousands of companies. It's a shareholder that can't leave, a permanent one. And shareholders vote on who sits on the board, on what the chief executive gets paid, on whether a merger goes through, across thousands of companies at the same time.
So is this the bit where I tell you a shadowy cabal runs the planet? No. And the real story is more interesting than that one. First, BlackRock has actually been handing voting power back. Through a program called Voting Choice, a large share of those index clients can now direct how their own shares get voted, instead of BlackRock deciding for them. Second, the sharpest critics here aren't conspiracy theorists. They're competition economists, and the argument they're having is genuinely unresolved. When the same few managers hold big stakes in every airline, every bank, every supermarket chain, does that soften competition? Serious people disagree, in public, with data. Anyone who tells you it's obviously sinister or obviously fine is skipping the hard part. But there is one thing about BlackRock that isn't ambiguous at all, and you can check it yourself in about 10 seconds. BlackRock is a public company. It trades on the New York Stock Exchange. It has ordinary outside shareholders, and those shareholders expect the profit to grow. Now, hold that next to Vanguard, its closest rival, and a company we took apart on this channel 2 days ago. Vanguard is owned by its own funds, which are owned by its own investors, so it has no outside shareholder to enrich. BlackRock does. Same industry, same trillions, completely different obligation about who gets paid first.
And that's the useful thing to take from all of this. When you're looking at any financial institution, how big is it is close to a useless question. Two much better ones. What is the power actually made of? Money or infrastructure or votes? And who is this company obliged to make richer? Because size tells you how much is at stake. Structure tells you what it will do. If that was useful, subscribe to Moneyverse. We take one piece of the financial system apart every week, and we tell you how it really works.